We are in a banking crisis, and we don't know where it's going. When you see one cockroach, there are probably more. I think that the financials are really at risk here, the most since 2008, so I think it's crazy that no one is talking about this. Just 2 years after the collapse of Signature, Silicon Valley, and First Republic Bank, a new banking crisis is starting to make its way through the markets. Except this time, it's not just the banks that are in trouble, it's the entire financial system cracking from the inside out. After all, most people don't realize that the banking system is currently sitting on hundreds of billions of dollars worth of unrealized losses. Regulators have just allowed them to borrow even more money to stay afloat. And even though it looks like everything's currently fine, with the market surging higher, these losses don't just magically disappear. In fact, even the CEO of JP Morgan warned that more cockroaches will emerge. That is why it is crucial to understand exactly what's going on, what this means for you, which banks are most at risk, and then most importantly, how you could put yourself in the best position possible, because there is a lot more going on than most people realize. Although, really quick, if you find this helpful, it would mean the world to me if you hit the like button, or subscribed if you haven't done that already. Yes, I really dislike asking for it, but it does help out tremendously. And as a thank you for doing that, here's a video of Bailey getting a treat. So, thanks so much, and also big thank you to the Gemini credit card for sponsoring this video, but more on that later. Alright, so on the surface, all of this starts with the original banking crisis, which I'll do my best to break down in under a minute, because as it stands right now, the banking system operates on what's called fractional reserve banking. This means that banks are only required to keep 10% of customer deposits accessible for withdrawal at all times. And if that sounds confusing, imagine it like this. You give me $1,000 to hold onto for safekeeping, but I could turn around to give $900 of that to somebody else who gives $810 to somebody else who gives $729 to somebody else. Under this situation, banks hope that enough people give them $1,000 so that when the first person wants their $1,000 back in its entirety, they have the money on hand to be able to return. The benefit here is that this allows people like you and I greater access to borrowing capital. It allows us to earn interest on our deposits, but it also relies on us having faith that the entire system works and also not asking for all of our money back at the exact same time. Of course, to be fair, in most cases, banks are not taking your money and lending it to banks who lend it to banks who lend it to banks, but instead they loan a small portion of that money out to other people, and then they invest the rest of it in very safe and stable assets. This ensures that as long as those investments are held to maturity, the bank gets a guaranteed return on their capital, you can pay back interest, and everything works swimmingly until it doesn't. For example, between 2020 and 2022, interest rates were held at 0%. This is a way for the economy to grow during a time when everything was shut down, and all of that money funneled back into the banking industry. In this case, though, US banks had so much money and interest rates were so low that a huge chunk of their deposits went into buying low-yield US treasuries, which plummeted in value as soon as the Fed began raising interest rates. Now, in a normal market, this wouldn't be that big of a concern because the banks still technically have your money. It's just illiquid until those loans mature. But small banks are the exception. And when their customers began withdrawing their money at the exact same time, that caused the liquidity crisis, which eventually resulted in 3 banks completely collapsing. What does that have to do with today, you might ask? Well, just like the banks of 2023 had significant amount of money locked up in low-yield treasuries which have plummeted in value, today the banks have their money tied up in another asset that's also not doing that well. See, during a time when treasuries were paying you next to nothing and bank deposits barely paid you 1%. If you were lucky, commercial real estate was booming because you could take a loan for 1 to 2% and go and buy a property that makes 3 to 5%. However, now that interest rates have increased, there is a problem. Commercial real estate values are plummeting, with Morgan Stanley previously having estimated that this segment of the market could decline by as much as 40%, which is the same magnitude as we saw during the 2008 financial crisis. Why is this such a bad deal for banks? Well, as CNN previously explained, barely pays you any interest. That's why more investment firms have started advocating for alternative investments that are not correlated with the rest of the market, like Bitcoin. These alternatives are seen as a way to diversify risk and gain exposure to assets outside the traditional financial system. This approach allows people to benefit from market movements without relying solely on banks or standard reward systems. At the same time, what's happening today brings renewed attention to the banking crisis. Much of the recent concern began when a regional bank disclosed a significant charge-off on loans tied to borrower fraud. Shortly after, another bank revealed a fraud-related lawsuit, raising fears that bad loans among smaller banks may be more common than previously expected. This intensified concerns across the financial sector. The situation escalated to the point where banks were forced to rely on overnight liquidity for a second time in a short period, something not seen since the 2020 pandemic. Adding to the uncertainty, Investment firms warned investors about potential losses linked to bankrupt companies, contributing to a broader market sell-off and renewed anxiety around bank stability. This raises an important question. How was this allowed to happen? After the 2008 financial crisis, regulations were introduced to limit risky lending. However, banks found ways to shift risk by lending to third parties who then made higher risk loans. As a result, this lending industry expanded rapidly, often without sufficient capital to absorb potential losses. Despite more than $1 trillion in loans issued under these conditions, it remains unclear how exposed smaller banks truly are and what types of losses they may face. In some cases, banks believed they had substantial collateral, only to discover it was worth nothing. These revelations reignited fears across the market and left many people questioning whether their banks could also be at risk. Currently, there appears to be a significant difference between large national banks and smaller regional banks. Major institutions tend to have more diversified portfolios and larger cash reserves. They have been stress-tested to withstand major drops in commercial real estate values and are generally considered capable of absorbing losses. Many are also viewed as too big to fail. Smaller banks, however, have greater exposure to commercial real estate. While not all losses are catastrophic, these banks are expected to tighten lending standards and face greater scrutiny over their loan portfolios. Still, credit rating agencies have stated that the banking system remains fundamentally sound and that isolated problems do not necessarily indicate a widespread trend. Default rates on high-yield debt remain relatively low compared to past crises, particularly 2008. Even so, lawmakers appear aware of underlying risks and have proposed raising deposit insurance limits as a precautionary measure. While this may seem like an overreaction to some, it reflects broader concerns about economic uncertainty. Overall, market anxiety is being fueled by multiple factors, including high valuations, geopolitical tensions, and rising commodity prices. From a risk management perspective, it's generally advised not to keep amounts exceeding insured limits in any single bank, especially smaller institutions. Diversifying accounts and assets can provide additional security. At the end of the day, even careful planning cannot eliminate all risk. This is why many people prefer spreading their funds across multiple financial institutions and asset types. While banks are currently holding unrealized losses, these are expected to normalize over time as economic conditions change. Still, uncertainty remains, and outcomes can never be guaranteed.